Everyone trades stock to make a profit, but then what do you do when the stock has no potential of increasing in price? Should you just ditch it and consider other investments with the potential to increase? Before you do that, do you know that you can still profit from your trading even when the stock price is stagnant? There are trading strategies you can explore for maximum profit even when the stock price is stagnant. Two such option trading strategies are the butterfly spread and the Iron Condor option. In this video, I will introduce you to these trading strategies and highlight the pros and cons of choosing one strategy over the other. Watch until the end of this video to know which strategy is the best for you. The butterfly spread strategy. It is a trading strategy that involves buying and selling options with 3 different strike prices, all expiring at the same time. The options are either all calls or all puts. It is called a butterfly spread because the profit-loss diagram resembles a butterfly with wings on either side. In a butterfly spread, an investor would buy one option with a lower strike price, sell 2 options with a middle strike price, and buy one option with a higher strike price. Sounds complicated? Let's take a practical example. Imagine an investor buys Apple shares at $80 per share, and the price will remain the same for the next 3 weeks. The investor will decide to go for a short call butterfly spread. He buys 2 call options at a strike price of $80 and sells 2 call options at $75 and $85. He pays $10 as a premium to buy those 2 call options at $80 and receives a $10 and a $1 premium for selling those call options at $75 and $85. As a result, the maximum profit the investor can make is $1 if the stock price is above 85 or below 75 on expiration. However, he may incur a loss if the stock price equals the middle strike price of $80. But then, the strategy limits the losses to $4, where the difference between the lower and middle strike price is $5 and the net income received is $1. Thus, this strategy comes with defined profits and risks. The goal of this strategy is to profit from a narrow range of price of the underlying asset. If the asset's price is close to the middle strike price at expiration, the investor makes a profit. If the price is too far away from the middle strike price, then it can incur a loss. Butterfly spreads are generally used when the investor expects the price of the underlying asset to be stable or stay within a certain range and is willing to limit potential gains in exchange for limited potential losses. This strategy involves very low risk. The Iron Condor Strategy. This is an options trading strategy involving buying and selling 4 options with different strike prices at expiration dates. It is a type of advanced option strategy that experienced traders employ to boost their profits. To construct an Iron Condor strategy, the trader buys one out-of-the-money call option with a higher strike price, sells one in-the-money call option with an even higher strike price, sells one in-the-money put option with a lower strike price, and buys one out-of-the-money put option with an even lower strike price. The strategy is designed to create a range of prices within which the underlying asset can trade, and if its price falls within this range at expiration, the trader makes a profit. If the price moves outside this range, the trader may incur a loss. The Iron Condor strategy is generally employed in markets where the trader expects the price of the asset to remain relatively stable within a specific time range. It is important to note that this strategy involves both buying and selling options, which can increase the complexity and risk involved in the trade, and it requires a thorough understanding of options trading. The investor can collect premiums from the sale of the 2 call options and the 2 put options to generate income through the Iron Condor strategy. If the price of the underlying asset remains within the range of the Iron Condor, the investor can earn a profit on the premiums collected. Butterfly spread versus the Iron Condor. The butterfly spread and the Iron Condor strategy are both option trading strategies that involve buying and selling multiple options with different strike prices at expiration dates. While both strategies are used to profit with limited price movement in an underlying asset, they have some key differences. The main difference is in the number of options involved. A butterfly spread involves buying and selling with 3 different strike options or prices with the same expiration date. In contrast, a Condor strategy involves buying and selling 4 different strike options with different expiration dates. Are you wondering which strategy is the best for you? Both methods have their advantages and disadvantages. The choice of which one to use depends on your market outlook and risk tolerance. The butterfly spread gives a lower potential profit but a lower risk, while the Iron Condor has a higher potential profit and risk. Your risk tolerance level might determine which strategy you will want to use. If you have a high risk tolerance, you can go for the Iron Condor. But if your risk tolerance level is low, the butterfly spread is a better option for you. You must thoroughly understand both strategies because they can be complex and risky, so it's essential to carefully consider the risks and rewards involved before using either strategy. If you are new to trading, consider getting a broker to help you while using any of these options so you do not make any mistakes. Neither the butterfly spread nor the Condor strategy is inherently better than the other. Both strategies have their own advantages and disadvantages, and the choice between them will depend on the trader's market outlook, risk tolerance, and trading goals. For example, a trader who expects the price of the stock to remain at $50 will choose the butterfly spread strategy, while a trader who expects the price to stay within the $40 and $60 range will choose the Iron Condor strategy. The profitability of both strategies will depend on various factors, such as the asset's price movement, the market's volatility, and the trader's timing. It is essential to thoroughly understand the risk and rewards involved in both strategies and the mechanic of options trading in general before deciding which strategy to use. Both these strategies can be complex and risky and require careful consideration of the potential risk and rewards. While they are both designed to profit from low volatility, they differ in their risk-reward profile and trading mechanics. Butterfly spreads offer a higher potential profit but also comes with a higher risk of loss if the asset's price moves too far in either direction. On the other hand, Iron Condor offers a lower potential profit but have a wider range of profitability and a lower risk of loss. If you enjoyed this video, consider subscribing, give it a thumbs up and let me know what you think in the comments. See you next time.